It is true that the market has reacted badly, as was to be expected logically, but the drop is not being too big either. In fact, what we were seeing on the screen was a drop right now in the futures of 0. Well, it was 0.2. Now it seems that it is a little bit bigger than 0.4. What we are seeing right now, the Nasdaq is different. Still, the pullback is not very big. Greetings already. Gonzalo Cañete, Head of Global Market Strategies for ATFX Connect. Gonzalo, good afternoon.
How are you, Martha? Very good afternoon.
Well, quite good data, of course. The market is reacting downwards, but the falls are contained. And of course, everything seems to be working in a way so that there is nothing that could create too much disruption for a market that is at record highs and also with results that have been very good in the last few hours, such as those of the target.
Right, yes. And well, I would add what Alexis said and what Gustavo said. They seem to me exactly the same. First, it seems that nothing scares the market anymore because we have almost promised the rate cut. And if in addition to this rate cut, which has already been practically promised, as we were saying, Voltic was the one who said a week ago that the rate cut would not be for March, but it would be for May. Therefore, it is almost taken for granted that there will be a rate cut. The question is whether it moves from 1 month to the next, but nothing more. And if you add to that macroeconomic data showing that the U.S. economy is holding up, then in principle, what Wall Street wanted was a rate cut, and now it has it. Therefore, good data on the U.S. economy can only attract more investment in U.S. assets. That on the one hand. On the other hand, as they said, the black hand that may be behind this, as both Alexis and Gustavo said, the massive fiscal expansion that the United States has had, the amount of spending, as we have said, it seems to be turning into an almost socialist economy, mutualizing absolutely everything and with a brutal expansion of spending because it can afford it, because it is the dollar, the world currency. If any other country did that, it would get into very serious trouble. But with the United States, as de Gaulle of the 60s said on French television, it is in part almost like an implicit swindle that they pay their debts with money that they themselves print. So on that side, I find it quite interesting. And then on the other hand, what should also be pointed out is that inflation continues to fall despite the fact that other variables are not adjusting. In other words, we have a mismatch between the unemployment rate and the inflation rate. The assumption is that as inflation rises, the unemployment rate falls and vice versa. This adjustment in the labor market does not occur. It breaks with the rules of the Phillips curve, of the most basic macroeconomic theory since the 50s. And therefore, it is a factor that we have to take into account, because perhaps then the disinflation we are seeing, the decrease in the level of inflation, may even foresee a more serious problem that we have already mentioned on more than one occasion, which is the possible risks of deflation, and therefore falls in sea freight prices, which we have already commented on and which are taking place in the last few weeks. Well, rises, sorry, but falls in food prices, which were mentioned by the IMF this very morning. So, Martha, these are factors that we could analyze, and we will certainly do it later on tonight at the close of Wall Street. But we will see how the market evolves during the afternoon. So far, it has not been bad news.
Well, we will see, and we will be looking forward to that analysis with you, Gonzalo, tonight. Gonzalo Cañete, Chief Global Market Strategist for ATFX Connect. Thank you.